most people are asleep right now. They're watching the headlines, trusting the system, and completely missing what's happening beneath the surface of the silver market. But history has always rewarded the few who move before the crowd wakes up. Right now, we are seeing signals that rarely appear together: massive physical demand, tightening supply, central bank panic, and a financial system under pressure. And when those forces collide, silver doesn't move slowly, it explodes. The next 2 weeks could change everything for investors who are paying attention. This isn't fear. This isn't hype. This is preparation for what could become one of the most unbelievable silver moves we've seen in years. Most people think silver moves only when headlines tell them to pay attention. They wait for television anchors to start shouting about inflation, economic collapse, or market panic before they even begin looking at precious metals. But by the time the mainstream media starts talking about silver, the biggest move is usually already underway. The people who truly understand this market know that the real signals appear long before the crowd notices anything. These signals are often quiet, hidden beneath layers of distraction, buried inside financial reports, central bank actions, industrial demand numbers, and shifts in investor behavior that most people never bother to study. Right now, those hidden signals are flashing at the same time, and that is exactly why the next 2 weeks could become one of the most important moments silver investors have seen in years. When you study history carefully, silver has never required permission to explode higher. It doesn't wait for economists to agree. It doesn't wait for Wall Street analysts to approve the move. Silver reacts when pressure inside the system reaches a breaking point. That pressure is building again right now. Across global markets, governments continue printing currency at levels that would have shocked previous generations. Debt is expanding faster than economic growth. Interest rates remain trapped between political pressure and economic weakness. Central banks are trying to appear confident while quietly preparing for instability behind closed doors. Most investors are still focused on technology stocks, short-term speculation, and distractions created by daily market noise. But underneath all of that noise, silver is beginning to attract attention from people who understand what happens when financial systems become unstable. One of the biggest hidden signals is the growing disconnect between paper silver and physical silver. Most people do not even realize there are essentially two silver markets operating at the same time. The paper market exists on screens, futures exchanges, and trading platforms where contracts are bought and sold in enormous quantities every day. But physical silver is entirely different. Physical silver is real metal that must actually exist, be delivered, stored, transported, refined, and purchased. During periods of stability, the gap between paper and physical markets can remain hidden. But when fear enters the system and investors begin demanding actual metal instead of paper promises, cracks begin to appear very quickly. Over the last several years, physical demand has been quietly increasing while available supply continues tightening. Industrial demand alone is reaching levels that many analysts underestimated. Silver is no longer just a precious metal sitting inside vaults. It has become one of the most strategically important industrial metals in the modern world. Solar panels require it. Electric vehicles require it. Advanced electronics require it. Military technology requires it. Artificial intelligence infrastructure requires enormous amounts of electrical systems that depend heavily on silver's conductivity. The modern economy is becoming more dependent on silver at the exact same time global mining production struggles to keep pace. That imbalance matters more than most investors understand. Unlike gold, which is often stored and preserved for generations, much of the silver used in industrial applications is consumed. It disappears into products, systems, and manufacturing processes that make large-scale recovery difficult or expensive. This means silver inventories can shrink quietly for years before the public recognizes the seriousness of the situation. By the time shortages become obvious, prices can move violently because industries are forced to compete with investors for the same limited supply. Another signal hiding beneath the surface is the behavior of central banks and institutional investors. Publicly, many financial leaders continue projecting calm and confidence. They insist inflation is manageable. They claim the financial system is resilient. They repeat the idea that markets remain healthy and under control. But actions reveal far more than speeches. Around the world, governments and institutions continue accumulating hard assets while simultaneously expressing concern about economic uncertainty. Gold purchases by central banks have surged globally, and whenever confidence in currencies weakens, silver historically follows gold with even greater volatility. The average investor often forgets that silver is a much smaller market than gold. That smaller size means money flowing into silver can create enormous price movements very quickly. A relatively small shift in institutional capital can send silver sharply higher because there simply is not enough available supply to absorb sudden demand. This is one reason silver has a reputation for explosive moves. It can remain quiet for long periods, frustrating investors and creating doubt, then suddenly accelerate upward with incredible speed once momentum begins building. Right now, another major signal is appearing through growing distrust in traditional financial systems. People everywhere are starting to question whether currencies will hold their purchasing power over the coming years. Inflation may move up and down temporarily, but the long-term reality is becoming difficult to ignore. The cost of living continues rising, housing remains expensive, energy prices remain unstable, food costs continue pressuring households worldwide. Even when official inflation numbers appear lower, ordinary people feel the difference every single day when they pay bills, buy groceries, or manage savings accounts that lose value over time. Silver historically performs best during periods when trust begins eroding. It thrives when investors stop believing governments can control every outcome. It rises when fear enters markets and people search for assets outside the financial system. That psychological shift is beginning again. Quietly, more investors are asking questions they ignored for years. What happens if debt levels spiral further out of control? What happens if currencies weaken faster than expected? What happens if geopolitical tensions disrupt global supply chains again? What happens if recession pressures collide with inflation at the same time? The media often treats these concerns like isolated events, but experienced investors understand they are connected. Economic weakness, geopolitical instability, currency devaluation, and resource shortages create an environment where precious metals begin attracting serious attention. Silver becomes especially important because it sits at the intersection of monetary fear and industrial necessity. That combination makes it unique. It is not only a store of value during uncertainty, it is also a critical resource required for modern industrial systems. Another hidden signal comes from investor psychology itself. Right now, many people remain emotionally disconnected from silver because the market has spent years frustrating participants. Long periods of sideways movement create exhaustion. Investors lose patience. Some give up completely. But historically, these quiet periods often appear before major breakouts. Markets tend to move when the fewest people expect them to move. The emotional fatigue surrounding silver today resembles previous moments before significant price accelerations. Complacency becomes dangerous because it blinds people to rapidly changing conditions. Meanwhile, large financial institutions continue operating inside a system dependent on confidence remaining intact. Markets today are heavily leveraged. Debt supports everything from governments to corporations to consumer lifestyles. When leverage dominates the system, stability becomes fragile. Small disruptions can trigger outsized reactions because so many parts of the economy depend on continuous liquidity and confidence. Precious metals often respond early when that confidence begins weakening. One of the most overlooked signals is how quickly sentiment can reverse once momentum starts. Investors who ignored silver for years suddenly rush into the market when prices begin climbing aggressively. Fear of missing out becomes powerful. Media coverage increases. Retail demand surges. Dealers experience shortages. Premiums rise. Social media amplifies excitement. This feedback loop can accelerate extremely fast because silver's market size is relatively small compared to other major asset classes. At the same time, mining companies face growing challenges increasing production. Environmental regulations, political instability, rising energy costs, labor shortages, and declining ore grades all create pressure on future supply growth. Many investors assume higher prices automatically create more silver production, but reality is far more complicated. New mining projects often require years of development, massive capital investment, and political approval before production even begins. Supply cannot instantly respond to sudden demand surges. The next 2 weeks matter because markets are entering a period where multiple pressures may converge simultaneously. Technical indicators are beginning to attract trader attention. Economic uncertainty remains elevated. Inflation fears continue lingering beneath the surface. Industrial demand remains strong. Physical supply concerns continue growing quietly. Investor distrust in financial institutions is increasing. These factors individually might not trigger an explosive move, but together they create conditions where silver can suddenly break higher with enormous momentum. History repeatedly shows that silver moves when the majority least expects it. In previous major rallies, investors who waited for confirmation often entered too late. By the time the mainstream accepted the bullish case, prices had already moved dramatically. Early positioning always carries uncertainty, but waiting for complete certainty usually means sacrificing the biggest gains. That is why experienced precious metals investors focus on signals beneath the surface instead of waiting for media validation. There is also an important psychological component to silver that separates it from many other investments. Silver represents independence from financial systems people increasingly distrust. During uncertain periods, owning physical silver provides a sense of security that digital numbers inside bank accounts cannot always provide. That emotional factor becomes stronger during times of instability. Investors are not simply buying metal, they are buying protection, flexibility, and a hedge against uncertainty. The growing interest in alternative assets further strengthens the case. Around the world, younger investors are becoming more skeptical of traditional financial advice. Many watched inflation erode savings despite assurances that everything remained under control. Others witnessed banking instability, market volatility, and economic shocks reshape expectations about the future. As trust weakens, interest in tangible assets grows stronger. Silver benefits from this shift because it remains relatively affordable compared to gold, while still carrying significant upside potential. Another hidden signal involves currency dynamics globally. The strength of the US dollar influences precious metals heavily, but the long-term trajectory of global debt and monetary expansion continues, raising serious questions about fiat currencies overall. Governments facing enormous debt burdens often rely on inflationary policies because reducing debt honestly through austerity becomes politically difficult. Over time, this weakens purchasing power and drives investors toward hard assets capable of preserving value. Silver's volatility also plays a crucial role. Unlike gold, which often moves more steadily, silver can experience rapid and aggressive price swings once momentum builds. That volatility scares some investors away, but it also creates extraordinary opportunities during major market shifts. When silver rallies, it often outperforms gold dramatically on a percentage basis. This is why experienced investors closely monitor silver whenever economic conditions begin deteriorating. What makes the current environment especially important is the convergence of fear and necessity. Silver is not rising solely because investors fear economic problems. It is also rising because industries genuinely need increasing amounts of the metal. That dual demand structure creates a powerful setup. Investment demand alone can create price spikes, but when industrial demand remains strong simultaneously, supply pressures intensify even faster. Market manipulation discussions also continue surrounding silver, and whether investors fully agree with those theories or not, one fact remains undeniable: silver prices have often behaved in ways that frustrate ordinary market expectations. Sudden sell-offs, aggressive volatility, and unusual trading patterns have created distrust among investors for years. But eventually, physical realities overpower short-term market games. When enough demand collides with limited supply, pricing pressure becomes difficult to suppress indefinitely. This is why hidden signals matter so much. They reveal structural pressures before prices fully respond. Most people only notice silver after headlines explode and prices already surge. The smarter approach is recognizing the warning signs while the market still appears quiet. Rising industrial demand, tightening physical supply, weakening confidence in currencies, Increasing global debt, institutional accumulation of hard assets, fragile financial systems, and shifting investor psychology are not random events. Together, they form a pattern that serious investors cannot afford to ignore. The next 2 weeks may become a defining period because markets often transition from calm to chaos much faster than expected. One unexpected economic report, one geopolitical escalation, one banking shock, or one major institutional move can ignite momentum rapidly. Once silver begins attracting broader attention, the move can feed on itself with incredible speed. Investors who prepared early may find themselves in position before the crowd realizes what is happening. Those who ignored the hidden signals may suddenly discover that the opportunity they dismissed has already begun slipping away rapidly. Most people believe the financial markets are driven by headlines, emotions, and breaking news stories flashing across television screens every hour of the day. They think billionaires, hedge funds, and institutional investors react emotionally the same way ordinary retail investors do. But that is not how smart money operates. The people controlling enormous pools of capital rarely announce their intentions publicly before taking action. They move quietly, strategically, and patiently. They position themselves before the crowd understands what is happening. By the time the average investor notices the shift, the largest opportunities have often already been captured. Right now, one of the most important hidden developments taking place inside global markets is the quiet movement of smart money into precious metals, especially silver. This shift is not happening because wealthy investors suddenly became emotional or fearful overnight. It is happening because experienced financial players understand the system is entering a dangerous period of instability. They recognize the warning signs that many ordinary investors ignore: rising debt, weakening currencies, inflationary pressure, geopolitical conflict, banking uncertainty, and slowing economic growth are creating conditions that historically push capital toward hard assets. The smartest investors in history have always understood one fundamental principle: when confidence in paper systems begins weakening, tangible assets become increasingly valuable. For decades, traditional financial systems benefited from trust. Investors trusted banks. They trusted governments. They trusted central banks to manage inflation and stabilize economies. They trusted stock markets to continue rising indefinitely. That confidence allowed enormous amounts of wealth to remain inside paper assets, digital accounts, bonds, and financial products dependent on stability. But trust is beginning to crack beneath the surface. Ordinary people may not fully recognize it yet, but institutional investors certainly do. They are watching the same economic pressures build that have appeared before previous financial disruptions throughout history. One of the clearest signs of smart money positioning is the increasing accumulation of precious metals by central banks around the world. Central banks do not make random decisions. They employ teams of economists, strategists, and analysts whose entire purpose is protecting national financial interests. Over recent years, central bank purchases of gold reached some of the highest levels seen in modern history. Publicly, officials may continue promoting confidence in fiat currencies and financial stability, but privately, their actions reveal a growing desire to hold hard assets outside the traditional paper system. Silver follows this pattern closely because smart money understands its unique role. Unlike many investments, silver is both a monetary asset and an industrial necessity. It benefits during financial uncertainty while simultaneously maintaining strong demand from technology, manufacturing, energy systems, and industrial infrastructure. This combination makes silver extremely attractive during periods where economic instability and industrial expansion exist at the same time. Experienced investors understand this dynamic well. Quiet accumulation often happens long before major price movements begin. Smart money prefers entering positions during periods of low public interest because prices remain relatively subdued and liquidity remains available. Once excitement reaches mainstream attention, institutional investors frequently begin reducing exposure while retail investors rush in emotionally. This cycle repeats throughout financial history again and again. Right now, silver remains largely ignored by the average person despite growing structural pressures building underneath the market. That is exactly the kind of environment sophisticated investors look for. Another reason smart money is moving into precious metals involves the growing realization that global debt levels have become unsustainable. Governments worldwide continue expanding spending while borrowing enormous amounts of money to support economies, social programs, military expenditures, and financial systems dependent on constant liquidity. Debt itself is not always dangerous, but excessive debt creates long-term consequences. Eventually, governments face difficult choices. They can reduce spending aggressively, raise taxes dramatically, default on obligations, or inflate currencies to reduce the real burden of debt over time. Historically, inflation becomes the politically easier solution because it operates gradually and often invisibly at first. Institutional investors understand this reality. They know that currency debasement has occurred repeatedly throughout history whenever governments accumulate extreme debt burdens. Precious metals become attractive because they cannot simply be printed into existence the way fiat currencies can. Silver possesses intrinsic scarcity that paper money lacks. Smart money recognizes that preserving purchasing power becomes increasingly important during periods where monetary expansion accelerates faster than economic productivity. Inflation itself represents another major reason experienced investors are quietly entering silver markets. Official inflation statistics often fail to capture the real-world experience ordinary people face daily. Housing costs, food prices, healthcare expenses, transportation, energy, and insurance premiums continue pressuring consumers globally. Even when inflation appears to slow temporarily, purchasing power erosion remains a persistent long-term issue. Smart money understands that inflation is not merely a short-term event but a structural consequence of modern monetary policy. Precious metals historically perform strongly when inflation weakens confidence in paper currencies. Silver becomes especially attractive because it often remains undervalued relative to gold during early stages of precious metals bull markets. Sophisticated investors closely monitor the gold to silver ratio because extreme imbalances frequently signal potential opportunities. When silver appears historically cheap relative to gold, experienced investors often begin positioning themselves before the broader market recognizes the setup. Another hidden factor driving smart money towards silver involves increasing geopolitical instability. The world is becoming more fragmented economically and politically. Trade tensions continue escalating between major powers. Supply chains remain vulnerable after years of disruptions. Military conflicts create uncertainty in energy markets and global commerce. Nations increasingly seek alternatives to financial systems dominated by foreign influence. These shifts create pressure on currencies, international trade structures, and investor confidence overall. Large institutional investors understand geopolitical instability often produces unpredictable financial consequences. During uncertain periods, tangible assets become increasingly attractive because they exist outside political promises and digital systems vulnerable to disruption. Silver's physical nature provides a form of security paper assets cannot always guarantee. That matters deeply to experienced investors managing wealth during unstable times. One important signal many retail investors miss is how quietly institutional positioning often occurs. Smart money rarely creates dramatic headlines announcing massive precious metals purchases. Instead, accumulation happens gradually through multiple channels. Hedge funds increase exposure subtly. Wealth managers advise clients toward hard assets quietly. Family offices diversify portions of portfolios into physical metals without attracting public attention. Mining investments begin receiving renewed institutional interest. Commodity funds slowly reposition capital toward precious metals sectors. These moves may appear insignificant individually, but together